Good evening, everybody. I'm Dan Hussey with Zaner Ag Hedge, a senior market strategist over here, bringing you our Strategy of the Week webinar, where we cover a wide breadth of markets, primarily focusing on commodities, as we are a commodities and futures trading broker over here. But with all that being said, remember, trading futures involves risk. It is not suitable for all investors, and everything we talk about here today is just my own opinion, not a direct trade recommendation. So, I kind of began off a few minutes ago before we really got really getting rolling here into this webinar that, the end of 2022 was a very kind of lackluster, in my opinion, a very lackluster end to the year. I think we were left with a lot more questions than we were left answered, and that could be, taken many ways. Many markets are, still in very large ranges, and the trade seems to be just finding periods of price discovery between the support and resistance levels that we've been captured between and entombed between for the last, several months. Once those bigger levels start to go, and we'll look at some of them today, and everything from the dollar index, the S&P bonds, crude oil, arguably even cattle and hogs are still in very range-bound markets. Absolutely everything here, including the row crops. One could be said when you take a big enough step back and look at price action on the daily, weeklies, and now even maybe sometimes the 4-hour charts, we're left with very little direction and trend trade to sink our teeth into. And being, primarily a trend trader in my background, it leaves us kind of, waiting for more opportunity around the corner potentially, or really for more signals, right, from the market to get active. Now, that's kind of been the tune we've been talking for the last couple months, right? We've been cautiously optimistic with a little bit more of a bull side bias in many of these markets, because even though geopolitically and from an economic standpoint, there's the risks of a recession and we're in a rate rising environment, market price action has done anything but fall apart. Yes, we have unwound major run-ups in the inflation trade that we saw last year. Crude oil is well off of its contract highs. Wheat markets are a great example. Cotton is down. All of those markets are well off their highs, but we are still trading, even at the lows of lows, right, that we've had recently. We're still trading at 20, 30, 40, 50% higher than the average price from the previous year, the previous 6 months. So with all that being said, I think I'd like to go back to the gaslighting we're seeing about inflation coming from government officials right now, telling us, oh, it's going great. We're taking care of it. It's slowing down. Notice that they're not saying it's over, right? It's not gone. Prices are still inflated. They're just not as inflated as they once were. So, okay, we're all getting burned by the fire here. We're just not totally engulfed in flames, right? Like, it doesn't matter. You're still on fire. You're still burning. So it's a tough time in terms of, in my opinion, because we're at one of those pivots and market cycles are changing. The inflation trade, had a big run up and is now unwound. That has caused a lot of now fear that price, asset prices may not go higher if we want them to, of course, for many of our producers and what have you. But we haven't fallen apart. And that's, I think, the thing to remember when you take that big step back. Okay, so that's a quick 3 minutes on, why, where, and how we got here over the last several months. We'll be doing a couple series of videos over the next week, breaking down individual markets, going a little bit longer depth. I was going to do one big video kind of looking at, the bigger picture in the last year on everything, but I feel that we have each market is so different that we could spend an entire hour breaking down the last year of news and price action that led us to where we are. Wheat's a great example. I mean, we would begin the year starting about the Ukrainian crisis, the run up on wheat, different infrastructure issues that we were running into that caused wheat to go bonkers, China buying and hoarding, all of these things. And then, the tune changed, and now we got to talk about a bit of a bear market for wheat. But that leaves us now, and because I'm on wheat, let's begin there. That leaves us now coming into a time period, in my opinion, where, and at least, some price action or some prices where we might be trying to find a low. And this finding a low is a process, and it takes a long time. And I wouldn't say that the low of lows is 100% in yet, because 2 days off of a low, a trend does not make. But at the very least, we are starting to see a reversal on the intraday and the smaller time frame. Okay, so that's not doesn't mean right we're going to go to the moon. It doesn't mean we're going to $10 in Chicago wheat just yet. But we are, at the very least, had traded an inside day. We've got an outside day reversal on a news event that was ultimately fairly bullish when it came to global stockpiles for row crops and domestic stockpiles for row crops. And now that that's out of the way, and we know really what the balance sheet looks like from 2022, there's no more questions going forward. Now it's a race for acres. Now it's the fight over how much we're willing to plant and produce next year. Okay, so the narrative, right, has been that exports have been waning, the dollar has been strong, and that's true of corn, wheat, and beans at this point. And that those trade winds are weighing against a market like wheat at this time. The 200-day moving average is still well above us, up at $9. I personally believe we need to see a move back up towards that area before really calling this 1250 area a top, and that we're in a protracted bear market, because everything that is off that high, as sharply lower as it has been, could still be a correction against the much larger continuous chart. When we take a step back of wheat, I have to ignore some of the spikes there at the end of contract. But we came from a $4 handle in 2017, broke out of that through 2018, 19, and 20, and now through 21 and 22, we're talking about doubling and tripling the price of wheat. We've seen this before in the history of wheat. Wheat going to $10 this isn't the first time. And when we unwind these trades, usually it's very violent. One of the things, though, that we need to be aware of now is the fact that we've broken out of that $7 area. It was a big resistance zone back into the end of 2021. It was the supportive area, $7 to $7.40 in the beginning of 2022. And then, just a war alone is what drove prices, that plus the overheated inflation trade, drove prices right all the way up to their highs. Started falling apart, fell below the 18-day, 100-day, 55-day, 100-day, and 200-day moving averages. We've had some death crosses since then, right? The 55-day is now below the 200-day, 100-day, and the 18-day moving average here gave us a cross. Well, basically, it was back in November. We had all those crosses happen, right? Where the failure to break back above $9, the death cross of the 55 and 100-day moving average, or the 200-day and 55-day moving averages through that time, suggested that, unfortunately, right, wheat was going to probably roll over to some extent. Now that we've broken below the $8 mark, though, we've been unable to break below the $7 mark. So very short time frame, right? No, it doesn't take rocket science to figure out since December the $7 to $8 range is important. The 18-day moving average, right in the middle of that range at 758, is our reversion to the mean. I'm cautiously optimistic and hopeful here. We've got a reversal signal both on the intraday and daily time frame and our daily RSI. We've come out of oversold conditions yet again for wheat. We've now put in an outside day to the upside. Tomorrow would be confirmation, and a run back towards that 18-day moving average and a move back above, in my opinion, could start some kind of multi-month, multi-week rally for wheat back towards, let's not get too greedy, but $8.50 and $9 in the near term, where the 100 and 200-day moving averages are right around. Well, $8.50 is just a psychological level that we kind of broke below there in November, but 100-day moving average at $8.30. I don't use the 100-day too much as an actual level to watch. I favor the 200-day and the 18-day moving averages for like more support and resistance areas in the market on the longer time frame. So, okay, wheat is Wheat, at least in the Chicago contract, also recently, and Chicago, KC, and Minneapolis, which I'm kind of just thumbing through here for us real quickly. There we go. Um, each, until actually this last week, both the KC contract and the spring wheat contract had both stayed above their summertime low. Here, the spring wheat contract here, Minneapolis wheat here at 875, they're low. KC down here at 811. Only spent a moment there trying to break below it, but the favored, or the the protein spreads here were favoring spring and KC wheat over the Chicago for some time, and we'll look at those spreads in a minute. But the Chicago is the only one that broke the summertime low. We are holding below it for now, but I'm watching the 760 area as a key, again, reversal level. Why? Because Chicago is the only one that went below this level. If we fall, go back in, alongside KC and Minneapolis spring wheat rallying back up in their ranges. Chicago's not going to stay put for very long. Okay. I don't much else to add on wheat until we see a little bit more of a confirmation of that rally. But in the very near term, we should still look at the 4-hour charts here. Chicago wheat, 50% retracement off its $8 high down to that $7.20 now low, $7.60. Lots of technical reasons to be watching that level. Of course, it's the type that might go up trade and then fall apart and head lower. That's why it's a 50% retracement short on this chart with a downside target of a test of 7. If you want to be a seller in wheat, the 760 to 770 area to me is where the next resistance to the upside is. We've broken the short-term trend line for the month of January lower, expecting now the market, in my opinion, to test our larger trend lines here, as well as those 50% retracements in some of those moving averages I mentioned before. We take a look at the KC wheat. Not much of a different story here. 50% retracement there from the 894 highs down to the $8 lows, right around 850. When we're looking at that KC wheat, that's that 18-day moving average yet again. So when I say reversion to the mean here for wheat on that 18-day moving average, it really is looking like more and more of a potential level. I still am holding true to the idea that I believe if you want to be a seller in the wheat complex, Chicago is the contract to sell. And if you're looking to be a buyer, look to buy the Minneapolis or the KC wheat, because the spreads that we've been tracking over the last 6 months have just continued to prove to us that the protein premium is still being driven in this environment. Let's take a look at those now before we switch over and get out of wheat altogether. Kind of wanted to get the wheat out of the way. And here we go. So KC Chicago in the March contract has generally been caught in a range between 30 cents over and $1.20 over. This is a spread that a year ago we were trading at as much as an 20 to 80 cent discount for KC wheat to the Chicago. And of course there is some pretty obvious reasons in terms of supplies at that time as to why that would be the case. But now that we're in a true, there's true demand, in my opinion, from the global market for wheat, you're going to still continue to see the protein premiums be driven here. Market basically came back down into trendline support. We don't follow too many close technicals on, spreads because they're not so technically driven. But you can't deny, right? You've had a pretty clear run up in price between July and November. Had a little bit of a correction in that trend, reversion back to the 100 and 200-day moving averages, respectively. Moved below that 18-day moving average, which is, in my opinion, still a great kind of line in the sand for this market and for the trend. And now that we've snapped back off of a 77 low here, back towards 92 cents over, we are fighting to break back above that 18-day moving average. If we go out to the July, this is where, in my opinion, there might be even more value added to a market because as you notice that March is already at to 90 cents over, and here the July is trading at only 70 cents over. So there's no rhyme or reason as to why a couple months later, right, we're all of a sudden going to not care that KC wheat has driving a premium for Chicago. Nothing's going to change between March and July here, right? And certainly after now that we know what the USDA has said in terms of our carryout and balance sheets. So the range here for KC July wheat, 60 cents over, holding support there. That's our old resistance, trendline support, 100-day moving average. And here, interestingly enough, in the July contract, and this is a case where I think July needs to kind of catch up with the March a little bit. We're actually breaking above that 55-day and 18-day moving average and closed above it here today. So a little bit more of a bullish, makeup to our chart, but I'm definitely expecting, a potential pushback to $1 over, which if we go back and look at where our previous cycle, the December contracts were trading, they were able to trade well over $1 over to $1.20 there. And again, remember, this is all in a bear market for wheat, right? Wheat has been going down in price, but the relative price of KC wheat has remained better bid or higher than Chicago. So even in a bear market, you want to be long wheat, spread it. It's the only way it's been making money. So something to consider. Again, long the KC, selling the Chicago. The trade is obviously has run its course somewhat, but the trend is there, and today's price action, I think, only was confirming that in the near term. All right, thanks for bearing with me through wheat. Let's get into our other row crops now. We're going to move into corn. March corn daily chart up in front of us here. Coming off of oversold there from yesterday's price action, barely. But there's not much to say here, right? If you had taken the average price between May and July, we have just come back to that average price around 670, 680, 660 to 680 time and time again. Every time we push a little too high, we come on back down, and vice versa. So without a doubt, there's a very, very clear, right, triangle, wedge. Love my drawing tools start working for me. There we go. On this chart. I think it can be definitely said that we have now hit kind of the apex, or the point of break for this market. I wouldn't be surprised over the next several weeks to see a move back above $7 and below $6.20, just to run both sides of this market. But when we take a further step back as to how far corn has come and what some of the bigger retracements and fibs say here, corn effectively traded, into a 50% retracement off of its highs. If you draw from like a 380 low, where we, started this whole rally in December in 2020 to its highs, that 50% level was right around, or right, my chart back here, was right at that 570 area. Just stay up there for me, would you? There we go. No. Anyway, there we go. So this is that 50% level. And so we pulled back into that 50% level, and we got a strong reaction off the charts. Well, wouldn't you know it? We got the exact same reaction, or 50%, another little 50% pullback. You know what? I'll do that. We'll look at the 4-hour chart here in a minute. But let's run over where those. My point is that there's another 50 back here into 640, and both have upside targets of like 740 and $8, and we'll go over that in a second. And this continual test of 650 to 640 just seems like retesting the support that is now proven to have held into today's price action. We're back above that 18-day moving average. We're back above the 55-day moving average, and we've traveled right up into the 100-day moving average here today, which was our short-term top. The 200-day is not much higher at 678. I would be really, really surprised if we didn't test that area here maybe tomorrow, into the weekend, into next week. But I do think we are coiled up for, a burst higher. How far or how sustained can that burst go? I don't know, but I think now coming out of this WASDE report and out of our quarterly grain stocks estimates, corn is due for at least a period of price discovery above $7 again. And if that's the case, why not tag a new contract high by March or May into the first quarter, into planting, where we typically see a little bit of a top before we can really commit to weather markets from the summer, which would really be the driving force for $8, $9, $10 corn, right? I don't think we're getting there without summertime news events that would drive price action, until the fields are on fire, is I guess what I'm getting at. On the 4-hour time frame for December corn, given that we are right into the middle of our range and the cluster of our moving averages, it has just been a multi-month consolidation. All right. March corn still has that open gap down at 589. Bull markets don't close gaps. We're leaving it open. We go down there. It's not a great sign for this market. 736 is an upside gap that we never filled. If you go back here, you can see it here from June 20th. The next push higher, I think that is the logical target for corn. I think we go a little higher. 745 is the technical upside target. Again, 573, that was that larger 50% retracement I talked about on the daily time frame. Its upside target of a negative 23.6 line is all the way up at 850. So technically speaking, fund traders who bought that 50% dip, or speculative traders that are in positions for that capacity, they have a upside target to look for. But so do short-term traders since July and August that bought this dip in October and December into the 640 area. That was a 50% retracement inside of our range. We talked about this level, how it was a little sketchy because we were basically between major levels inside of a choppy range, and at that time there wasn't much that said we couldn't go to 620 before rallying. Well, we didn't. We rallied right on off it up into 681. That rally even broke the backs of the short, so to speak. If you drop a 50% short from the 711 down to the 634s, the market saw no love at 50%. It went up to the 618 lines, ran through them. In other words, if you were a seller at 50% and you had your stops at 618 lines, you got immediately stopped out in a 2-day trade. And that type of price action is sometimes indicative of who is winning this war, right? The 50% long off the lows is clean. So if you're talking about this range and the progress one side might be making inside of the range, the bulls are winning. The bulls are holding their technical levels. The shorts can't. And even inside of today's, this last little leg, you can make a great case. Yes, Dan, 630 to 685. The longs didn't have any shot here either. Holiday markets. Last week of trading into the new year. That's okay. No one's home. You wouldn't expect high participation at technical levels in that time frame. Okay? Arguably, you'd say the same thing for the run up there, but that's fine. At that point in time, if you're just looking at price action, in a vacuum from October through December, neither side is really in control yet. Okay? Yes, on the bigger picture, there's some swings that might be, enough to take us higher, but from October to December, no one's been in control of this market. That changed today, in my opinion, when the market did once again, had a chance to rally, went through 618 lines of the shorts. I am interested now, if the market is generous enough to give me a dip down to 665, 660, I'm a buyer in corn, stops below the 650 area for a breakout of the 680 area towards 735. This is being done for some clients right now because we're lucky to own the 650 puts as part of another strategy that we were doing for protection into this report. For a great example, it's a losing trade, right? This was a terrible idea. This is the worst day in the world to own puts on a news day where it goes up. But the idea was that we bought a January put in corn the 650 put, 8-9 cents was the cost on it. Okay, and then we were doing this yesterday as protection into this number, into today's release. We then sold the 615 put in March, so a month later. So they're both off the March contract. So the underlying, future that we are trading is the same. But the idea was that we were giving ourselves for, 4-cent cost, because we were selling that 615 put and brought in about 4 to 5 cents. For about 4 cents of out of pocket, 4 or 5 cents out of pocket cost, we had 35 cents of potential downside protection on this news report. And I was happy, and certainly, I was willing to take the risk that we move down to 620 or 615. Maybe get out of that, protected position, because, hey, if we move down to 620, that would be an area that I probably would have liked to have been a buyer at for other reasons. But now that we've, held support, we've moved up in the range, we're just kind of left holding a 650 put and a short 615 put. The short 615 put is going worthless. We sold it for 4 or 5 cents. It's trading at like, I think around 2, maybe a little more there. But the moral of the story is we're going to probably be buying that back or letting it go worthless for a penny or nothing. And then you're just left with owning a 650 put, right? Well, that is also only worth like 2 cents. So you lost 6 cents there, right? All day you could have only lost 4 on that strategy. But the idea now is that it leaves us owning the 650 put for the next couple of weeks. It's a great opportunity to buy, corn on a dip here against that 650 put. And hey, if you don't have a trade on right now and you're saying, Dan, I want to get long corn, I don't know. And by all means, if you want to sell corn, I think there's just going to be a higher price to do it at here, right? I think we'll go a little bit higher and you'll get a better price. Don't get me wrong, from a hedging standpoint, these are great levels, right, to do and get some cash sells done at. No one's going to deny that. But if we think today's report was the start of something more, as I think it might be, looking at those February puts in corn, the 650 put right now is going for 2 to 3 cents. It's got 14 days left on it. Okay. If you're willing to risk 20 cents in the corn and putting a stop down at 650, for 3 cents, you can have the guarantee you'll never get ticked out of that trade. And when I say the guarantee you won't get ticked out, I mean that the market would go down, run your stop, and then potentially reverse higher and take you out of the equation, right? But for a couple pennies, and hey, it looks like even the 660 put today is going for 6 cents. I'm in favor in this type of environment of using options with 2 weeks left on them as a stop loss for long positions, particularly in corn right now. This is kind of the sweet spot that I like to utilize these in, so everyone's aware. And this type of trade is referred to as a synthetic call. So if you like being long corn, but you don't like being long futures, you don't like stops, but you don't want to buy an option like a call because you'll just lose time value on it, buy a put instead and go long the future, right? Of course, work out the actual cost and risk, right? Because if you're long corn at 672 where we closed, and own a 660 put or 660 put, you've got 12 cents of market loss there until your put kicks in. And then the cost of the put at 6 cents means you're really spending 18 to 20 cents to have that protection. Now the benefit of using a put rather than just using a stop or something, and these are just multiple ways to skin the cat, is that if we were to go down to 660 and then rally, you don't run the risk of having your stop getting hit, but you don't have any more risk. So again, at the cost of owning that support, right? I think everybody understands the idea of a put protection, or I'd hope. There's definitely a way to use puts and calls outside of just a hedging tool themselves. We can use them for protecting speculative trades or actual trades that we're looking at. So that's what I'm looking at now. I like the idea of corn going higher here. I think there's a technical reason to be a buyer in a dip. I would not be surprised, to see the next move in corn push us above this 680 resistance and then give us a pullback to buy the dip. And if that's the case, there'll be plenty more to talk about. All right, so let's take a look at soybeans now. March soybean futures traded big breadwinner on the day, trading up 20 some odd cents there into the close. I thought we were threatening to break out of the uh, December high there for a few minutes, but we definitely settled back down into the end of the day. The 18-day moving average is at 1490. I don't think we'd go down there. I think the 1500 area as a psychological level now is going to be very likely supportive. I would not be surprised, even if that we closed at 1518 here over the next 24, 48 hours into early next week, though, to see us test 15 to make sure we want to hold it as support. Market doesn't have to do that, but I think it's at least worth considering that could be the case. 200-day moving average here at 1449, the 100-day at 1446, and the 55-day moving average at 1463. All the major supportive, kind of levels below us if we were to go down there to think about. But it's tough when we haven't broken out of, the range, so to speak, to really get excited just yet. Because, arguably we are still below the contract high. We are definitely above, our late summertime high there and early fall high. The question is how far, how much higher can this market go? I don't see any reason $16 isn't on the board, or a possibility at this point. I think it's just a question of how fast and ferocious it wants to get there. Again, we're going into a period where we're going to see a wrestling match over the acreage this year. Cotton prices are so low. Corn prices are rallying. Soybeans have been rallying in the face of wheat and beans for some time now. Or soybeans and wheat and corn, excuse me. So something's got to give here. Beans keep rallying the way they are. Corn can't stay put. Cotton won't stay put. And we'll get to cotton in a little bit, but that is one of my favored potential trades going into the first quarter of this year, is that I think cotton has a lot of catching up to do, and we'll get to that in just a minute. All right, let's break down the 4-hour chart here for soybeans in the March contract. Pretty choppy. Not very clear type of wave. I'm not worried too much about that. I've retired my Elliott wave long ago. I still am knowledgeable on it, right? But I do not use it as a means of finding 5-wave structures to guess when a trend's beginning, because I found that misled me more than not. Channeling, though, higher we are. And we are pushing up into the old highs. I mean, there's not much else to say here other than we're in a period of price discovery higher. We had 3 days worth of consolidation here and 1 day worth of inside price action going into our news report. And then our breakout has begun. This is both a breakout of, that psychological $15 level. It's a breakout of our old summertime highs. It is a second coming of this old top that we had. And now anyone that was a seller into the end of the year and has stops above that high, this market is threatening now to potentially head up there and maybe want to take out at this point. So yeah, I like the corn. I'm interested in being a buyer in the dip here in the soybeans as well. I think that a test of $15 is where I would, at least in the very near term, kind of focus my energies, as that's the level we struggled so long to get above. But one thing I do hate here is that we kind of already had that breakout and test intraday today, after the into and through that news release. So wouldn't be surprised to see another whatever you call pullback here. But I am interested in trying to position in beans again if that dip comes. I'm just not willing to chase it here, and I think that arguably corn has a clearer risk reward ratio in terms of a trade, right? But we'll see. Who knows? Real quick on soy meal and oil. Soy oil was a one second here. Let me get our March contracts up because we really don't have any business with our Jan for right now. Soy oil has really, there we go. That's what I wanted to see. The oil has surprised me, and in terms of how it has just not followed the meal here. And I'm wondering if this isn't because of some of the new EPA guidelines that we've seen because of canola, putting it on par with soy oil for blending and biofuels and for biofuel production. Um, Certainly, the palm oil markets have not helped or contributed to a rally here. So you're really seeing veg oils just continue in this sideways, lackluster price action. And some of that is very likely because crude oil is just not rallying yet, right? Well, except for today, right? In the last couple of days, we've generally been in a downtrend in soy oil or crude oil. So our veg oils, in terms of their biofuel hopes, we don't have that energy bid in here. And then soy oil just seems to have more working against it now because it has become an alternative, or there are now other alternatives to it on the market. That is not the case for meal, though. So sideways price action. I think the low end of the range here is this $60 mark. Okay, 62s is holding. I think that from here, the market should see a period of price discovery higher, right? This is just the ebbs and flows of the market. We've had a down period, maybe a little up and a little down. We're coming out of oversold conditions, just like everywhere else. So I do think that there's a period of price discovery higher. Let's test that 200-day moving average. Actually, let's get back up to 70 and test more towards the range highs here. But there's not much in terms of price action to sink our teeth into other than this pullback that we recently had into little small 50% retracements and the hopes that our other, right, soy products will start carrying through. We've got a meal-driven rally underway. And the consolidation between 380 and 420 that happened, December through last year through October of this year. I mean, really, I guess it broke out in December. But soy meal finally breaks out here. And you got to wonder and ask yourselves, what's holding back soybeans at this point? Because this is a substantial breakout. And I would imagine that the price of soybeans needs to reflect this, particularly when soy oil is not doing anything to change those margins, right? It's not like soy oil has swapped values here with the meal and is down at $50, right? With soy oil or meal breaking out, that would keep the price of beans stable. But if one of these assets is moving higher and the other one's not, the crush spread just doesn't make sense, right? Crush margins are getting hit here. So now that, we're into the first real crushing, what do you call it? Now that we're coming into the first crush report of the year, it'll be interesting to see if that stays true. Okay. Cattle. Actually, no. Before we get into cattle, I alluded to and talked about the dollar index earlier. Let's take a look at that real quick. Dollar index, pretty big sell-off that we're starting to see in the near term here. We're down now to testing the 100-101 figure. This is a major, major support for the dollar, but I don't see it holding. Going out to a continuous chart here for the dollar index on the daily time frame. Bear with me while I zoom way, way out here so that we can see the long-term price action at least coming up from our 20 teens lows. There we go. The dollar has generally found itself in these 10-year ranges. Okay, for about a decade, we go into substantial ranges, and the last couple were 7 to 8 years, whatever. The point being is that 90 to 100 was important. Before that, 90 to 70 was important. And, even going on before that, we can take this back further. But what I want to point out is that over the last 10 years, the range between 103 and 90 finally broke out. And now we've pulled back to test the old breakout highs. Once resistance, now support. My issue is that this market isn't showing any signs of wanting to stop yet. It still seems very, very, very heavy. And we have now sold off back into that old range. And I believe that if we break below 100 here, this is just a blow off top for the dollar. And we are heading back down towards potentially 90, right? It's a kind of an age-old false breakout narrative going on that took 6 months to play out. But nevertheless, if the dollar continues to decline, that's only going to help our export markets. And I see no reason why many of our row crops or other, strongly strong markets that are strongly influenced by exports would sit still. Okay, wheat being one of those major leaders, right? So dollar index kind of breaking back down into its old range. Let's take a look at the smaller time frame, but our moving averages now, right? The 55-day moving average, death cross below the 100 back in middle of December. Today, we got the 55-day breaking below the 200-day. So not to say that means we're going to go straight down from here. Usually when you see these crosses happen, like the market will actually kind of say gotcha and rally back up to test those moving averages as resistance. But the 18-day moving average at 103.70 is the near-term line in the sand for me. The dollar's going down until it's not. We're into support where we could be, expecting a little bit of a snapback for the dollar. But I actually think one of the trades to start this year will be selling the U.S. dollar in a rally and move back to 106 or towards the 100-day moving average at 108. I think would be gifts to be able to sell into it this time. And this also feeds into the narrative and the idea that if the Fed is pivoting, right, we're hearing that a lot in the news, and all it means is, okay, we were raising interest rates, that drove up the value of the dollar. Now if they start whacking interest rates and taking things down, that ends up becoming negative for the dollar. And the simple idea there is that when interest rates go down or negative and there's quantitative easing, they're literally printing money to feed the beast. When interest rates are higher, they start taking money out of the system, right? The demand for dollars is still there. And so the value of the dollar relative to other currencies goes up. If you really want to get down to it, it's as simple as this. You can borrow in Japan for like 1%. You can convert that yen to US dollars and use those US dollars in the United States to lend out at 3 or 4%. That's what we refer to as risk-free carry trade arbitrage. Big banks do it, and it's been one of the biggest trades of the last 40 years between the 10-year note and the Bank of Japan. You can almost set your clocks by those cycles. We saw a deflationary period coming out of World War II. Japan pegged their currency while they rebuilt their economy. In the 70s, they depegged the yen for 30 years through 2012, or 40 years through 2012. The yen rose in value relative to the dollar. Then in 2012, the Bank of Japan went into their QE affinity policy. The U.S. also started to pull back on quantitative easing, and that reversed this carry trade in a real way. If you go and you look at a chart of the dollar yen, we came from the 2012 lows, and we have retraced half from 2012 through today, from 70 to 150 in the dollar yen, is half of the decline of the dollar yen chart from 300 down to 70, roughly, right, that it took from 1970 something through 2012. So the velocity of how those things unwind and the money that moves around that the dollar index somewhat represents is almost unfathomable to most people, including myself. It's just so many zeros. It's ridiculous. But when that many zeros moves around between central banks' balance sheets via the treasury markets and other carry trade currency swaps, it has massive implications. In fact, why don't we just look at the dollar yen chart real quick? I'm not going to look at nat gas today, but we're not going to be able to look at all of it. You're going to have to trust in the fact that I have looked at this chart profusely throughout my career. But we were looking at a daily chart, and we'll go back as far as we can. I think we can at least see the 70 lows. There we go. The 70 low that we formed in 2012, the dollar yen going higher is effectively the dollar relative to the yen going up in value. It would be much like the dollar index going up. And actually, if we go even further out, I want like a weekly or monthly time frame here. There's a weekly time frame. Perfect. Weekly time frame here. Market ripped out 150 highs. This massive three-wave correction, 1, 2, 3, could be a multi-generational move in the currency. Which means if the dollar yen is collapsing from a 50% area, and remember, it started off at around 300. So if we draw from 300 all the way down, to 70. Oh, it's a log chart. That's no fun. Anyway. We have retraced, not quite the 50%, I guess, what have you. We've retraced 35 to 40% of that, okay? This is a very quick move over a 10-year period that took 40 years to do, right? So market kind of took 2 steps down, and now it's taking 1 step up is what I'm getting at. Anyway, moral of the story, dollar yen is, the level I'm looking at is like the 125 figure. So even on the spot currency chart here, the dollar is not at support yet. 125 there would be where we'd be interested in, and we're still falling. So, okay, let's see. I think the dollar's got a little further to go, and if it goes much further, I don't know if it's going to have much, in it to rally, but we shall see. All right, let's move into cattle, and we will finish off with the S&P and bonds and crude. Cattle will be pretty quick here. Mainly because I think we can just focus on the small time frame that we're in. All right, we're gonna start with the feeders here. Man, feeders just cannot break out of 185 in the Fed and in the Jan contract here. Yeah, we'll probably be moving on out of the Jan really, really soon, right? But it's still our near-term month. We've been in a very tight range between 180 and 185. Personally, I'm a seller in the cattle at these levels. I think that we have run our course in the feeders. You flip over to the fats. This is April. I don't want April up right now. Let's look at that Feb. It means pretty much the same difference if we really want to get down to it. But there we go. Feb getting up there to the contract highs, and we just get no breakout. We're still consolidating above the 18-day moving average, but in my opinion, if we see the feeders and the fats both roll over here, fats get below 156, feeders get below, let's just call it 181 at this point. I think that we are, setting ourselves up for a little bit of a pullback in the near term. And this is mainly because we've basically been having this ending diagonal structure. And there are some Elliott wave counts that I still religiously pay attention to. Running flats are one of them. The high probability wave structures that make sense to me. This one is what I refer to as an ending diagonal in the live cattle. It is a terminating structure. I mean, basically, unless the market rips out like no tomorrow, we are probably in some kind of ending structure that has lost momentum and diverged with every new high. Each push higher, if you measure them, is smaller and smaller in price, and it causes this rising wedge-like structure. This is different than a rising wedge pattern that a lot of bulls would talk about, or that is a continuation pattern, because this is happening at the end of a move. When we go back and we look at a continuous contract of Feb cattle, here, we're at pretty extreme levels for the last 2-3 years, right? And I'm not saying we're collapsing in cattle and going to unwind this entire thing, but in terms of the Feb cattle, a move back down to 150 to 148 is not out of the question. With the cluster of moving averages, the 150, the 153 or the 200-day moving average, the 154s here at the 100, and the 155, 55-day moving average, is plenty of support here to go back down and test. But like I said, if we are looking, if we're cattlemen and we're looking at these markets and not sure what to do, of course we're always going to be hopeful and optimistic that we head higher. But the last month and a half, we just haven't seen it. And unfortunately, I think we're heading into a time where seasonals might just stop agreeing with us for a period. And we certainly have the end of month cold storage and cattle on feed reports that might spark a little more interest in this market. Feeder cattle's lack of ability at all, when we look at its continuous contract, and certainly at the smaller time frame, or the non-continuous, its ability to break out of 185 and kind of putting in a double top here on the continuous, as well as just on the outright Jan, not even getting up there towards its highs of 190. I don't see any reason to believe fat cattle are going to break out here with the feeders looking, I don't want to say super bearish, but like this is not, how a trending market should look, if you will. We've been consolidating sideways in a range. We're right in the middle of that range, so there's nothing we can sink our teeth into right here from a directional standpoint. But with fats going to new highs and contract highs and the feeders failing to, that is a diverging signal there that puts, the trader in me says, hey, look out. The trend we had into this, period might be ending or showing signs of exhaustion. Because remember, these are trends that set up from like March of 2020, right? Like these are multi-year trends in cattle now. We're back to great prices in cattle. We were in a complete depression there. I mean, it was shocking. I couldn't believe it. I thought the world was never going to eat meat again or something. But needless to say, right, markets correct themselves, and justifiably so, cattle prices have gotten back to where they should be. Rising corn and beans here, not going to help cattle either in the near term. So, over the next month or so, I wouldn't be surprised to see a little more downside, kind of unwind those the bigger trends in the bigger chart. And then, there's going to be a bottom not too far away where I think cattle might, come in as a buy yet again. Real quick on the April pigs here. Lean hogs just getting absolutely crushed. That's actually our spread. Oh, where's my... There it is. Feb lean hogs. That's what I want. Yeah, still getting crushed, right? Right? It doesn't matter. It's the same idea. But big old range, right? We've been down here to 78 before. It held. We're way oversold. I wouldn't be a buyer just yet in lean hogs, but this has been proven support since September, October, the low end of our range. We're still very oversold in our daily RSI, but a nice key reversal signal, if you get one of those little reversals happening and the RSI turning back positive, definitely think a reason we should take a look at lean hogs here and consider, a move back above 80 for a move towards 90 if the market presents it. I think there's, again, there's some USDA tape still to print here that maybe the market knows something we don't. I know there's fears of Chinese demand not being there and what have you, but it's certainly a range until it's not here. And not saying you buy the low end of the range outright without like a little reversal signal, but if it gives one, there's a good reason to think we'll just see a period of price discovery back higher inside of this range, because arguably the pigs have been caught in a $10 range for some time. All right, we did just have the open, so why not take a look at where our row crops kind of opened here. Pretty flat, not surprising to see that. I'm not really expecting them to run away on me here, but I also would almost like to see, a little more confirmation of a move higher. And then, that Friday, Monday pullback that we sometimes see after a news report. And that might be an opportunity to get into the long side for corn, wheat, and beans here. So that's what, we'll be kind of monitoring or paying close attention to, right? All right, and without further ado, let's take a look at crude oil, the bond market, and the S&P 500, and we'll call it a night tonight. Boy, it's a fun market out there. All right, so crude oil going out. Got to look at that daily chart. know where we've been. That March of 2020 low was historic, right? Front month crude, or deliverable crude, I should say, went negative. For those that don't know, the only reason you saw deliverable crude, in other words, the crude that was going to be delivered, right, for that month, not spot crude, not where you could go out and buy a barrel of crude from a dealer, right? We're talking crude that has no place to go because literally all storage was full. And all of a sudden this crude is coming out of the ground and it's being delivered, and people quite literally said, no, you're going to have to pay me the cost of new storage for this stuff, hence it going negative. That was really only an issue for funds and for actual hardline traders. Your retail, your average, most retail investors weren't a part of that because they weren't allowed to trade a deliverable contract at that time, right? But the front month futures still made it down to $6.50 a barrel, which you look back on it and it's like, why couldn't we have all just put $100? Why didn't we all just buy $100? Just raw take $100 bill and go buy what 18 barrels of crude, right? For $6.50. It stinks that we don't have that kind of opportunity. But jokes aside, wow, Okay, but that's a learning lesson for the psychology of markets, right? Things got so bearish, and arguably maybe at highs here, we got so overly bullish. People think it's never going to be worth anything again, and people think it's going to be the end of the world because it's going, the price is going to infinity. And it's interesting how it doesn't matter what side of the spectrum you're on. Everybody thinks the worst is happening. All right, so 50% pullback in crude is $68. Biden administration saying crude hangs out down around the $70 mark for a while. They're going to start buying that stuff back and replenishing the strategic oil reserves, which is a big reason, after this 110 area, we just kind of fell apart. We just saw systematic selling in every single rally of crude because our government was literally out there dumping oil on the open market. Now that they have sold off everything they can afford, now it's time to buy it back. And I'm not shocked that crude has not even tried to test below $70 because of that. Anytime Uncle Sam says we're going to do something and they start doing it, like with real money, right? This isn't like the Fed talking. This is like actual purchase and sales of real crude in the economy. There's no way the world is going to let them get it for any cheaper. They told you they wanted it at 70. They're never going to let them buy it for less, in my opinion. Not until it's restockpiled. And then prices might go down, and then it looks like a terrible losing trade. I hope for the sake of our strategic oil reserve that isn't the case, but I hope for the sake of all of our wallets at the pump that we don't see $100 a barrel in crude again. Unfortunately, I don't think that is realistic at this point. The market pullback is a lot like wheat. We unwound the massive run-up we saw in prices, but we are still hanging on to average the price of the last 2 years, which is about $50 a barrel. We are still 53 to 60% above that level. Okay, we're not at 300 times that level or 200 plus times that level at $1.30 and above, but we could get there, right? Okay, so the inflation trade unwound, whatever. We came back just like wheat and just like a lot of our markets. We came back to test, this area of broken resistance on the market, on the chart, right? We have got a couple highs here that from 21 through 22 was the resistance on crude until, for all reasons listed before, we finally broke out. Still very much in a downtrend. You can't deny that. But we are seeing, reasons to think we're trying to find support and trying to find a low, just like on wheat and cotton, which I apologize. We will look at that again because here I am saying that's one of my favorite markets to be watching here in the first quarter, and I haven't even talked about it yet. But stay tuned. We'll get to it. So this wedge, or maybe a little bit of sideways price action here, being formulated between the 82 area and the 70 area. 70 is not only the big 50% retracement of the charts, it's also very vocally where the Biden administration has talked about refilling the strategic oil reserve. But we are running into the 50% retracement from our last swing high, which is around the 94 area. Downward sloping trend lines at this point, which have actually proven to be a pretty good, really, really good trend line here. Yes, we did have to kind of adjust it there for a little bit to this new high, but generally speaking, this trend line since July has just been on point, with the exception of a couple days where we had a fake out there in November. That has been a level that the market has clearly been following and into. Anyway, that trend line now is up around the 86 figure, so get that back on the charts here. Okay, yeah, okay. It could be at 81, but if you draw it to this new high, it's up around 86. So 81 to 86, there's probably some resistance on this chart. But certainly if we get that move back towards 90, now we might be talking about really setting up in a trend higher. But it's a little hard to say that too, because you can make a case for some other highs and old resistance there as well. But nevertheless, inside of this move for crude, I would like to see a move above 82 or below 72 before committing, positionally to anything on a real kind of way. But I do think that if there was ever a reason to think that, there's a move towards 90 to 100 happening, I think at this point the market has kind of proven that there is some support here at 70. So I am starting to look and price out call spreads in this event, but I haven't really fallen in love with anything yet. So we'll just let sleeping dogs lie for the time being. Again, there is not much to sink our teeth into on below this daily chart. I'm going down to an hourly chart for the sake of looking at the short-term time frame in crude. We do see a bit of an uptrend beginning, and we're going to want to continue to see basically pullbacks get bought, but at this time I'm not expecting crude to get back below 77 if we're going up towards 81 to 82 at this time. Okay. And if you've joined us throughout the webinar or you're joining late, there'll be recordings of this up, so don't worry, you didn't miss anything. Okay. So I'll finish with cotton. We'll do the 10-year and the S&P real quick. The 10-year, I actually have maybe a little bit more to say than the S&P, but 10-year futures, or it's the 30-year futures, the bond market. 10 years, very similar chart, but we are now running into our channel resistance on that daily chart. When we broke below the 130 figure, we went down to the 116s. We highlighted, a move back towards 130 as the area we would like to be a seller at, or we found resistance, and we think that resistance could continue to hold its old support back from the summer months. It's the 50% retracement from the 145 swing down to the 117s. And it is that downward sloping trend line against the highs that we've been holding. Today we started to push above that level. A retest of 132 and this old high isn't out of the question. But I am concerned that if we break out here, there's not much in the way, in my opinion, of resistance again until we get up towards the 147 area maybe. And that, interestingly enough, that 147 area, right, is if we start to break down some of these bigger levels, I guess it's 154. And let's see, where's our old swing? Is there? No, then we've been stair-stepping lower from there. Okay. Needless to say, okay, it's not just one. Why did I say 147? So yeah, the old high at 145. Oh, because I had only looked there. Yeah, my apologies, everybody. Let me just shut up and fix my chart to show you the level I'm considering, right? Above 133 to 135. I think the 150 to 155 area. Okay, it's the old lows, right? Proven lows. That's what this box is showing you, like the supportive area that we broke below, and you'd come back up to test this resistance. The full 50% we're short off the entire high here is at 154. So above 133, certainly I think you'd say above 137 here if you invalidate. We'd potentially, could consider this market in a rally back up there. But with all intents and purposes, we're just right back up into our old resistance. So far, January is inside December's price action. And certainly if this market doesn't think that the Fed is going to do enough in terms of their rate rising, you could see the bond market, catch a bid here. If the Fed, heck, into the next cycle, we know that we've got a few more basis point hikes, to go here, a few more Fed meetings where we're going to see those hikes continue, which is a big reason why I think that the upside is probably limited here. I think this is just a second test of this resistance. I'm not going to sell it into a second test personally without it kind of rolling back over a little bit first. But I do think that I don't think we're going to get above 137-ish here. And that we should probably see at least another move down towards 120. I don't think we're going to be heading substantially lower. Is it possible to go down to 110? Absolutely is. But a lot more has got to come out of the Fed, I think, to convince the market to take interest rate futures to those extremes. Well, it looks like wheat, corn, and beans are all turning a little bit more green here. Again, I'm not surprised to see this follow through. But I would, again, over the next, into Monday-ish, I am looking for a possibility of a pullback, to position on. So we'll see. All right, S&P 500 trading above 4,000 yet again today. CPI came out, saw some volatility there. But this market is actually holding a 50% retracement from the 3502 level to highs. That's at 3842. Upside swing targets are at 4340 from here for that. The 50% short in this last decline from 41.85 down to the 37.89 low, we're coming up on the 61.8 line at 40.50, which, by the way, there's a downward sloping trend line here that began from our all-time highs right now through the highs. This looks like a chart that is coiled up ready to break out to me. I think we've got to move up to 4,200 to 4,400 in the works, and this could be a bear market rally. Don't get me wrong, this whole move up to 4,400, 4,500, it could get to 4,800 and still roll over and collapse down to 3,500. Why do I say that with such conviction? Or why would I believe a move like that is possible? Well, it's happened before, just at different price levels. If we go back to the period between 2010 and 2011, yeah, here we go. Well, I don't know. Kind of not a great example, but here you go. Right? 300-point swings up and down all of the course of a year. This is, of course, a much larger time frame than I'm referring to, but or trying to get at here. Where the heck is it? All right, it doesn't go back that far. I need a monthly chart. Oh my gosh, 20 years ago is only 2023. I need longer than 20 years. Jeez. Here it is. This is the price action I'm trying to show you. So it has definitely happened over a different time frame, right? This is multiple years. This is 2 recessions, dot-com bubble burst, 2008 housing crisis, right? Well, fine. Condense this down and pretend this is like a couple months. This is possible in the S&P, right? It is absolutely possible to see a move all the way up to 4,800 and then back down to 3,500. That's nothing for this type of market. But what I do want to point out on this monthly chart, and actually I guess the S&P, I don't even care about the short time frame anymore. We just went over it. I'll give you my case as to why I am still bullish the S&P, why I think in my lifetime we'll see it to 10,000. And it's all because we've seen moves like this before. We've seen big recessions, big pullbacks, and then huge periods of expansion. This is, the period of expansion and inflation from 2010 through 2020 that we'll talk about in the history books. It is not so different as, the period of expansion that we saw going back. This only goes back to 1985. I guess it's the SPX for us. Much better. Boom. So going back 40s through the 70s, little three-wave move here. 20 falls back down to 60. Nobody believes that the market's going to go to new all-time highs. And at that time, if you had told somebody the market was going to trade to 1,200 in their lifetime, they probably would have laughed at you. But just give it a couple years, right? Flash forward to the mid-80s. Black Monday. 220 low, or 200 low off of a 380 high, or 340 high down to 220 low. We then bust out within 3-4 years to new all-time highs. And then we see the greatest period of expansion the stock market has ever seen. Big recession in 2001 and 2008, very similar to our 1970s progression. Financial crisis, global turmoil, lots of reasons to fear the market. Within a couple of years, we're already through to new all-time highs. The market's now trading right off of a 1,500 to 600 handle up to a 3,400 handle into COVID. And then guess what happens? Millennials Black Monday. Literally, it was a Monday too. COVID announcements sent the market into turmoil. It's basically just like Black Monday in the 80s. It's basically a 2-day event. Push through to new all-time highs, and the market starts to pull back. We've seen this before. After Black Monday, the market had a pullback into a 50% retracement from a 370 high down to a 300 low. That was the last buying opportunity at 300 before the market just never, literally just never looked back. If that's the case, this buying opportunity at 3,500, kind of multiplied it by all these numbers by 10 every 20, 30 years, it works out pretty nicely. That might have been the last buying opportunity we'll ever have in our lifetimes. And the market may never look back on its way to 10,000. I don't know. I'm kind of hoping it goes up and comes down to let me get, longer in 401k and put more money to work in the stock market, but in names and things that I personally like. But at the end of the day, I don't see why everybody's so afraid. I'll be perfectly frank. If you want to know the wall of bull market, or, the wall of worry of bull market climbs, you're staring at it. Nobody anywhere is confident in this market. Confidence is what forms highs. Fear is what forms lows. And when we're somewhere in the middle, everybody's just a whole lot of confused. And those with conviction are the ones who end up making money, hopefully, if you're convinced of the right side of the market. Anyway, I wanted to put out the case there that from the millennial Black Monday low of 2,100 to the 4,800 highs, we've pulled into our 50% retracement. And now if we go back to our S&P, and we know we're coming off of that 3,500 50% retracement, and we're looking at the futures now. I'm going to go down to a 4-hour chart again. Let's break down the move inside of that, a little bit here. 50% short off the highs. Can't argue from 4,800 down to 3,600. Bears got their short at 4,200 filled and took it down to new lows. Not quite to a target of 3,300 like they would have expected. They took it right down into that 50% long at 3,500. And boy, the bulls took over. And they retraced that sell-off almost entirely. And then a second round of sellers were there again at this downward sloping trend line in this 50% short to whack the market back down. But how far down did they take it? Not far enough. 3,500 lows to 4,183 high. 3,842 is the 50% retracement. The bulls took it and are railing it back up. Now they're putting pressure on the bears. The bears have another level to sell into, 4,000 to 450, maybe up to 4,200. But at this point, if we start pushing above 40.50, I think that's it. I think that is a case for the market getting to 4,400, not in a straight line, of course, but a period of price discovery now to start taking out some prior highs and to run stops there. Are we going to have enough to take us to new all-time highs and beyond? I don't know. Past performance in the market is not indicative of future performance, but the analog is there. This is a complete pattern in terms of time from when the recessions in the 70s began comparatively to the recessions in the early 2000s to the new all-time highs after to the millennial Black Monday scare events and the Black Monday scare event in the 80s and the Black Monday scare event in the in 2020. Everything about the situation is very similar. So there you go. If back then the market traded from 100 to 1,000, it's going to trade from 1,000 to 10,000 over the next cycle, and we're just in the midst of that, in my humble opinion. But this is where I try to really make a point so that people are not as fearful about the market as they need to be. All right, we actually only have 8 minutes. I've been going for almost an hour and a half. We got 8 minutes to go here. So let's finish off with cotton. Got March cotton coming up here on the chart. All righty. Cotton, one of those markets that saw the early love of the inflationary move, and then a massive unwinding of that trade over the last several months. In fact, in terms of the decline, only really crude saw a big of a decline. And interestingly enough, the fall from 130 down to 70 is exactly the fall we saw in crude, just over a slightly different time frame. So, yeah, much like the fact that we're maybe looking for a bottom or hopeful a bottom might be trying to form in the crude market, I think the same could be said here for cotton. But cotton's a little more promising because I think the extreme low in a three-wave move down has been felt. Back in October, November, we were eyeing this trade. We were waiting. Actually, we've been eyeing this trade since September. We were waiting for that move back above the 18-day moving average. It tested it there in early October, but unfortunately never got the follow-through you need for confirmation. So now we're still below that 18-day moving average coming into October. Market has a multi-day limit up type move to take it back above those levels. In other words, we went from selling in price discovery to being oversold to now short covering. The shorts start to cover once they get above that 18-day moving average. That's where the fund traders who'd been selling this thing down, that's where their stops were. If you look how our limit up move, the second day of it was above that threshold, followed by a third into overbought conditions. We go up to test 90. The 100-day moving average, the 55-day moving average, can't quite do it. We revert to the mean back to the 18-day, but we don't really break down all too much in cotton. In fact, we only pull back into a 50% retracement from its 70 low to its 90 high, right into 80. A technical buy and a pullback for cotton if we think the low has formed and we're starting a period of price discovery higher. Well, the market didn't really get enough have enough, in it to break out of 90 just yet, but the support is there at 80 and has been proven at 80 multiple times. And now we've got upward sloping trend lines, and today's sell-off after a WASDE report that suggests to me we're just consolidating here in a bit of a wedge that, the closer we get to 80, the more and more I want to be a buyer in cotton, and certainly I am eyeing at this point $90 calls. On this dip, I think owning a $90 call out through, we might need to go a little further out than I'd want. But, of course, buying outright futures on this dip with stops below 80 is an idea. But with 28 days left on cotton, March, and 91 days left on May, and trading at about the same levels, the $90 call in May, little pricey at 346. We got to get to 93.46 for it to break even. But turning that into a call spread by selling the 103 and cutting that price almost in half, that's not a bad idea in terms of risking about $1 and call it $1.50 to $1.75 actually to buy the $90 call. We cap out our gains at $1.03, but we got 91 days to get there. I think that is totally achievable. Even so, at 80, trading at 82, I mean, we're only a couple days away from of limit up type price action from seeing which by the way, cotton does historically do. So, betting on limit up in other more liquid markets is not advisable, but I wouldn't say betting on it, but you have to expect cotton, sugar, and some others to trade limits more than many others. Anyway, the $90 calls here over the next 20 days are going for $1. So either way, we can get away with, risking, and if you wanted to spend the same $1.75, we can take that down to, 87. Anyway, here's a way of getting, positioning here in cotton with limited risk on this dip. I don't know if the downside is quite done yet. I do think, given that this was not a limit down day, repeat, we were not limit down today. After a news event like that really weighed on cotton, I think we will see follow through. I think we could see a test of 80, maybe even one more push below to run the weak stops. But generally speaking, I'm interested in being a buyer somewhere in the 78 to 80 area. Certainly wouldn't want to see this market get down to fill our gap at 75.50. So I probably would have, stops somewhere around this in the 76 handle if I was using futures. Because if we go down there, bull markets don't fill gaps, so to speak, right? So leaving that gap open and consolidating above gives me a general idea for a trade. We have a level of support that we want to participate and be a buyer at. We have upside targets. A breakout of 90 is the first one, and really a move back towards, I think, the 200-day moving average and the 100 figure is probably in the works. So our upside targets can be defined here. And then we've got levels below us we can use as stops. You can say the 70 figure if you really wanted to risk, $10 here, okay. And if you wanted to risk less than that in the futures, there's a gap here on the charts that, about $1 or so in front of it might be a place to place that stop as well, or maybe at that gap around 75.70. The point being is we've got a level to define risk that might provide some kind of technical invalidation that we don't. We would no longer be a part of. But I'm not putting orders out there or advocating buying cotton just yet. I don't see the setup intraday that makes me confident to buy a daily chart. But I am eyeing, right, for that move and for support down into that area at this time. Well, that concludes this week's Strategy of the Week webinar. Big, long one. Thank you for joining with it. We covered a lot today. If there's any ever questions or any other information you want to get from me, you can always reach out to me at 312-277-0110. Find me at Daniel Hussey Jr. on Twitter, Dan SOTD on Facebook, and shoot me an email at dhussey@zaner.com. This has been your Strategy of the Week webinar for December 12th, 2023. Thanks for joining me, everybody. I'm Dan Hussey, and we will be back with you as price action develops. Take care, everyone.